The conversation on short-term insurance continues, this time after an executive order is signed. I'm Bryn McBride of ABC for Health. We're talking about an executive order signed by President Trump dealing with association health plans and short-term insurance. We're going to focus our attention today on short-term insurance. Let's remind ourselves what that is before we talk about what the order says. It's a limited benefit plan. It's not impacted by the Affordable Care Act requirements. There aren't essential health benefits in short-term insurance. It's less comprehensive, and therefore it's a lot cheaper. It's meant to be that little insurance package you get if you need to bide a little bit of time of coverage. Many people know that it's not an alternative to the individual mandate, meaning if you only have short-term insurance and not a qualifying health plan in the marketplace, you are subject to the penalty for not having insurance. It formerly was restricted to 90 days in duration. The short term meant 90 days. This was a rule coming out of the Obama administration, restricting short-term insurance from what it used to be, which was 364 days of coverage. Now, short-term insurance is not that broadly used right now. There are only about 30 companies across the U.S. that sell short-term insurance, covering only about 160,000 people. Today's order, the executive order signed by President Trump, instructs the feds to look at ways to expand back out that availability of short-term insurance, starting by making sure that it expands back out to 364 days in duration, and looking to see if it can't become more prolific. The devil will be in the details, and we'll talk about that in just a second. But once again, this order is making sure that the short-term insurance is not following individual mandate. What's not sure is if that penalty will go away. This order has to be implemented after regulations are written. The Department of Treasury, Health and Human Services, and Labor will be drafting regulations that tell the states how this will be working. Now, when they do that, they're going to have to make some key decisions about whether or not that individual mandate penalty is going to stay around or not. Now, what's happening, however, is open enrollment. From November 1st through December 15th, people will be going to the marketplace for the first time to purchase insurance. Because the regulations have not yet been written on the order, that delays the implementation date of it. So you might think, well, we're okay then for open enrollment because people will go and buy their marketplace plan, and this shouldn't pull sales out of the marketplace until it becomes available. Well, people might not purchase health insurance through the marketplace during open enrollment if they think they can hedge their bets and buy a short-term plan later. So what is this doing to the insurance marketplace? It's destabilizing it. There have been many articles and speculation written interviewing different insurance commissioners, health policy experts, and they're all using the word jittery. We're a little jittery of how this is going to work, both open enrollment and short-term insurance plans. These plans, if you remember from the pre-ACA days, have a history of leaving consumers with large medical bills and therefore large medical debt. Why is this? Well, because they don't have to follow those essential health benefits. So you could have a short-term, cheap plan that you think's got you covered through gaps in insurance that you might otherwise have. And when you do come into an instance of needing medical care, you find that that short-term insurance just isn't going to cover your needs. Bills start to rack up, so does medical debt, and therefore so does uncompensated care. Now, like we said, this is not immediate. This has to be drafted into regulation, and then there is an open comment period. The public is invited to send comments in, weighing in with their opinion of the impact of this order. Nothing should be implemented by the end of the year, but of course we will start to see some long-term risks to the Affordable Care Act. It's just seen as another way to chip away at the Affordable Care Act through the back door. Repeal and replace was tried. It was tried in the House at least 60 times and it wasn't successful. It was tried most recently in a very public display, including the American Health Care Act in the House and the Better Care Reconciliation Act through the Senate. Neither of those repeal and replace attempts were successful. This attempt to start doing executive order to chip away at some of those provisions of the Affordable Care Act is seen as that backdoor approach to getting what the Republicans and the House and the Senate GOP wanted all along. Short-term insurance plans are designed to attract the younger, healthier consumers, pulling them potentially out of the Affordable Care Act market, leaving that Affordable Care Act marketplace as the sicker, older, more expensive plans. Again, a destabilizing move for that Obamacare marketplace. You can read the order yourself. You can also read some of the news articles that have been going into this in quite a lot of detail. The order is short on details and big on rhetoric. So you might actually learn a little bit more from some of these news sources that we've selected that give you a little bit more inside information into some of the conversations that were happening as this order was being drafted. You can keep your finger on the pulse and stay in touch with us. You can share your healthcare story, send us an email, or ask us a question. You can do all of that at healthwatchwisconsin.org. Thanks for joining us.